I want to be able to accomplish two goals here for you all in this section. First of all, how to effectively save money. And that's different than investing. We'll talk about that in a little bit. And then, second of all, we'll talk about some of the common types of accounts that you can put money into, specifically for the purpose of savings. And so, those are just different types of savings accounts that we will explore. So, as I've just enumerated right here, those are the things that we are going to focus to work to understand. So, obviously, there's a lot of different purposes and reasons why people want to save up money and have money set aside. We could list a number of common examples, right? So, you might be trying to be able to purchase some sort of a whatever, fill in the blank. So, that might be like a car or a vacation or something that you are trying to be able to purchase, right? A lot of people also try to save up money for down payments for specific things, oftentimes for a house or for a car or something that's going to significantly cost quite a bit of money. Saving up for college expenses, tuition, fees, room and board, all that sort of stuff is another common saving goal that people have. Saving up for retirement. And some of these bigger things you should actually be really investing money for, but ultimately we could fit it into the saving category as well. It's really important to also establish like money if you need it for an emergency. We'll talk about an emergency fund after a little while, and you can keep going. So there's a lot of reasons that we will be able to save money. So ultimately, you should of course decide what it is that you need to save money for, or that you want to save money for. And so what we want to get into now is talking about what are some effective ways that we can save money and avoid spending money to be able to accomplish our goals, right? So I do want to spend quite a bit of time here helping you understand the similarities and differences between saving. So I'll put that in the left-hand circle of this Venn diagram, and then investing, which I'll put in the right-hand circle of the Venn diagram. So they do have some things that are definitely in common. So first of all, one thing which you can do, of course, with these is you can store money. You can put money into a savings account or into an account in which you're investing. And the second kind of main way in which saving and investing usually are similar in is that they gain interest. You accrue some interest when it's stored, usually in a savings account or some sort of an investment type of an account. Now, they are different in a number of different ways that you should understand. So, when you are saving money, and we use that verb to save, you're usually trying to save up money for goals that are more in the short term. How we define short term is kind of subjective, if it's 1 year, 5 years, or whatever, right? But it's usually something that's not a larger sort of value. Versus if you are investing, you should be investing money for a very long period of time, so a number of years, over a longer term, because you're trying to make your money grow faster, because you're trying to usually save up for a larger amount of money. So if you're putting money aside for saving, the interest rate that you will have in a savings account is going to be much lower than if you are investing, where you're going to see the interest rate is going to be much, much higher for you in investment accounts typically. Because when you're investing, you're actually probably trying to put it into like mutual funds or stocks and things that, of course, come with more risk, but much more return if it turns out favorably for you. So along those lines, then saving is much less risky because you're not usually putting money into risky investments in stocks. Maybe you might throw it into like a government bond or something that doesn't really have a lot of risk. But yeah, if you're investing, there's definitely going to be a lot more risk involved, in which you might lose a significant portion or maybe even all of your money involved with that. So in a savings account, you're putting money into what we call a liquid account. So by it being liquid, the money is fluid in that you can put money in at any time that you want, and you can also take money out at any time you want. So that's what we mean by liquid if you're putting money into a savings account. Versus if you're investing, you're actually buying assets. Like stocks, bonds, mutual funds, annuities, shares of those sorts of things, to be able to hopefully get a greater return on your investment. So not just a return, but let me erase that, and then to get a greater return than you actually bought for, hopefully. And that's your goal when you're buying those sorts of assets. Again, stocks, mutual funds, that sort of thing, right? Yeah, so those are the big things that you should think about in terms of saving and investing. So if you're saving up money, it's usually a lower cost thing that's going to be more in the near future. If you're investing money, you're going to be buying assets to try to make your money grow more exponentially. It's going to be over a longer term. It's going to be for bigger things like mortgages or retirement or that sort of thing. Right? Awesome. Obviously, there's going to be a lot of barriers that are going to hold you up when you're trying to saving in terms of obstacles that we face. So, as humans, right? We like to impulse buy, right? You're by the checkout line, you see the candy there, you want to grab a candy bar. That could be a thing that, might be a habit that you have that you want to try to avoid to try to save up money. Another common thing that's a problem for people all over the world is credit cards. Versus just paying money. As we all know, it's so much easier to just swipe a credit card and then spend all that money versus physically seeing money go. So trying to avoid just swiping away and buying things online all the time, right? A huge obstacle to saving is that of inflation, which means that the value of the dollar decreases and things become, generally more expensive and all that sort of stuff. That's a huge obstacle to saving because when you're saving, you have such low interest rates that oftentimes inflation is beating that, which means that your money really isn't growing in value over time. It's actually losing value over time, even though it's gaining money, if that sort of makes sense. Yeah. So that's going to be an obstacle. A lot of Americans also live paycheck to paycheck. And so that can prevent a huge obstacle as well, just in terms of not being able to save money. And there's so many other obstacles that can come in the way, right? So I just wanted to make sure that we recognize and acknowledge that. A lot of experts will say different things about how much to save, which is a common question you may ask. I think a lot of experts would kind of agree in the ballpark of 20% of your income should be set aside for saving. So this includes everything like including your retirement, any saving that you're going to have, emergency. Typically around 20% of your annual income should be set aside to save up for, these things that you're seeing in the pictures here, like for college, for your house, for whatever it might be. But ultimately, you need to establish your priorities and needs and wants to help you decide how you're going to budget your money accordingly based on, what your income situation is and all of that sort of thing. Yeah, so some good saving strategies to kind of help you out in terms of thinking about ways to save up money. One huge thing I would recommend is for you to pay yourself first. So, what that means is you should actually set aside your saving money first, and then you should pay for other sorts of stuff. So, like when you get your paycheck, make sure that you actually take some of that money from your paycheck and it goes into saving. And then after that, then you can start spending money on like your movie tickets or groceries or whatever, that sort of thing. So it just forces you to actually save money. Whereas a lot of times people will like buy all their groceries and then go see a concert and like, oops, I don't have any money left over, right? So if you actually prioritize your saving first, that can really help out to make sure that you are saving up the money that you need for your car or for whatever it is that you're trying to save up money for. Another strategy I would recommend is to have a separate account for your saving. So if you just put all your money into a single checking account, it's hard to kind of just like save a certain amount of money from that account. So if you actually set up a separate account that's specifically for saving for whatever it is that you want to save for, that can be really helpful. Obviously, some of the kind of more common sense sorts of things would be to cut some of your expenses. So, quit buying your coffee every morning from the coffee shop or whatever, right? And you can figure out ways to budget accordingly. If you set goals, savings goals for yourself, okay, I'm going to set aside $10 every 2 weeks for this or whatever it might be, right? And nowadays, there's a lot of money saving apps that you can look into. If you just Google it, you can find lots of ways in which you can save money on purchases that you make at certain stores and such. Okay, so we'll kind of end the last piece of things here, diving into types of accounts. Before we get into savings accounts and the specific types of them, I just want to make sure that we address the differences between that of a checking and a savings account. So they definitely have similarities, of course, right? So in a checking account and a savings account, you can definitely store money in them. And not only can you store money, but that money can move. So you can deposit and you can also withdraw money from a checking account and a savings account without any penalty or any fees or anything like that. Um, so if I put checking account in the left-hand circle, and then I put savings accounts in the right-hand circle, then we can describe some of the differences here. So typically in a checking account, you're going to see that the money is really going to be able to go in and out. So you're able to spend money directly from a checking account by writing out checks, using your debit card, etc. But money can also go directly in by cashing checks, having direct deposits, etc. Versus a savings account, the money is usually meant to stay in until you have saved up for your savings goal and then spend it on what you need to. So typically that's the purpose that you want to have for a savings account. Yeah, I mean, other than that, you're not going to see too much difference. You might see there might be kind of some interest that you accrue that might be a little bit higher versus a checking account. There may be interest that you accrue or not. It just kind of depends. You'll just have to kind of do your research in terms of looking at checking account options and savings accounts options. Yeah, so in terms of opening up a savings account, there are some things that you need to make sure that you have to be able to actually open up a savings account. So you definitely need some form of a photo ID that is issued by the government. So oftentimes like a driver's license or something like that would suffice. Obviously some information about yourself like birthday, social security number, etc. Also, there's going to be usually an initial deposit that's going to be required of you, whether that's $10 or $500 or whatever it might be. The other thing that you should know too is you're going to need to be 18 plus or have some sort of a co-owner with you to be able to set up that savings account. So there are a number of different things that you should kind of think about and perks that you should kind of consider. So things to consider would include thinking about whether there are ATMs, if they're convenient, if there's accessible, if there's any fees associated with that. That should be a question you should ask. You should think about whether or not there's going to be any online or mobile banking that's going to be provided to you with this. Also thinking about whether there is insurance. So if you're going to a retail bank or a credit union, if there's FDIC, NCUA, insurance that's going to back you up. Definitely ask about the interest rates that's going to be tied to the account, whether it's a 0.1% interest rate, that sort of thing. And then also if there's going to be some sort of a minimum balance requirement. So what that means, if there's a minimum balance requirement, is that you need to at least keep that much money in your account. You can't ever go below that. So if there's like a $25 minimum balance, you always have to keep $25 or higher in that account. Or otherwise, if you go lower, they're probably going to like charge you a fee or something like that. Awesome. All right. So now we've arrived at looking at different types of savings accounts and the characteristics of these. So pretty much any bank or credit union that you go to is going to offer these three types of accounts. So a savings account, which is just kind of a more basic option. Now, the banks and credit unions that you go to might have a fancy name for them, like they might call it a student savings account or basic savings account or some just like whatever name they come up with. But every bank should have just kind of a basic plain Jane savings account that anybody should be able to open up. Money market accounts are a little bit more serious and can offer you a little bit more returns. And then finally, a certificate of deposit is another type of savings account. So I want to help you understand just some of the characteristics of these. First of all, starting with the minimum balance requirements that's associated with these. So typically with a savings account, you're going to see none or maybe like $10 or so or $25, usually a pretty low amount that they're going to require of you in a savings account. I'm just going to write the word yes for the other two in terms of like there's always going to be a minimum balance and that can vary and be much higher. So it might be $10, but it could be like $10,000 or $50,000 or $3,000 or something. It just kind of depends on the terms. So just know that there always definitely is going to be some sort of a minimum balance requirement in a money market account or in a CD, certificate of deposit. So in terms of interest rates, kind of nowadays in 2023, these are typical interest rates that you're going to be able to see. So typically about 0.1% is the annual interest rate that you're going to see on savings accounts. Know that just if you go online, it could be a little bit higher interest rates. So something to just kind of think about in terms of your research. Know that these interest rates are variable at for savings accounts. By being variable, that means that the interest rates can vary while your money is invested. So it might change, it might go lower, it might go higher, and it varies with something that we call the prime rate, which kind of helps. It's an index that kind of helps establish where banks should set their interest rates at, and it really just fluctuates with where the economy is at. So if the economy is doing really well, then the interest rates could go higher. And if the economy is not, then these interest rates for deposit accounts would go lower. Money market accounts typically stay underneath 1%. They're kind of in the middle-ish, so anywhere kind of between around 0.5%, a little lower, a little bit higher is typically what you'll see for money market accounts. For a CD, you could get lower than 1%, but if you wanted to get a 1% rate, you'd probably have to keep your money in there for 3 or more years, so 3+ years. Know that you can get 2 to 3% interest rates sometimes for CDs, but you would just have to keep your money in there for a very long time and then also probably put in a lot more money. These interest rates for CDs are definitely fixed rates, so they'll never change during the time that it's in the CD whatsoever. So in terms of being able to make deposits and withdrawals from the accounts, you are able to do so in savings accounts and money market accounts. So you're able to add more money or take money out without any fees. But for a CD, the answer is a no, and there are penalties if you decide to take out money too early. So you really want to think about a CD as like you have to lock away the money, and it'll be in there for the set term. So if it's a 60-month CD, it's going to stay in there for 60 months. Or if it's a 1-year CD, it's going to stay in there for the full year. So it's really an investment that you would only want to do if you know that that money, you're not going to need it for that set term. But the benefit is then that you get a much higher rate of interest, and then the bank also gets a larger sum of money, which they can use to, loan out to people and make more money. So basically just kind of some things in general to know is that a savings account is really just ease of access for you. But kind of a con of it is that there's a little growth in the account because there's not really a high interest rate going on there, right? If you're going to invest in a money market account, it's going to be better if you have a larger deposit than just a savings account. And don't need to access much, but it's money that you will still be able to access, right? Otherwise, if you are doing a CD, it's really going to be good only if you set aside that money when you have large amounts that are going to be set aside and for a long period of time in which you don't need to access the money. So again, that money is locked away if you put it into a CD. All right, just one last thing just to note is that an emergency fund is something that you can set up and that you should set up. So generally, advisors recommend that you should set aside 3 to 6 months worth of expenses in an emergency fund. So when we say expenses, you should be thinking about things like all the bills that you have to pay, all the groceries you need to have, things, like things for your mortgage payments, that falls under the bills category. Just whatever it is that you need to kind of pay for to get by. So this would, if you get into like a medical emergency, you lose a job, whatever it might be. And what I would recommend is this should be a separate account that you set up for yourself so that in case of emergency, you have to set aside this money to help you out. So just in terms of saving, something that you should really prioritize and have in your financial savings plan.